In 2011, Jeff Bezos held a personal net worth of roughly $18 billion. That same year, he reported an income so low that he legally qualified for and received a $4,000 child tax credit from the U.S. government. This split-screen flowchart shows exactly how that math works out. On the left, a standard paycheck is immediately reduced by income and payroll taxes before it hits a bank account. On the right, a dollar gained through the rising value of unsold stock bypasses the IRS completely. The tax code targets realized income while ignoring the growth of unsold assets. As this chart expands, the end result becomes obvious. Leap ProPublica data revealed that America's 25 richest individuals paid a collective true tax rate of just 3.4%. Meanwhile, a typical middle-class earner pays roughly 22%. This massive gap relies on a highly effective, decades-old wealth preservation strategy known by tax professionals as buy, borrow, die. It involves zero illegal evasion, operating entirely within the legal provisions written into the tax code. The system operates on two distinct tracks. One track taxes the daily labor of everyday workers, and the other permanently shields the paper wealth accumulated by the elite. Step 1 of the strategy is buy. The ultra-wealthy concentrate their money into appreciating assets that generate zero annual taxable events. They buy growth stocks and private equity. Private equity involves taking ownership stakes in companies that are not publicly traded on a stock exchange. These assets silently multiply in value without triggering a tax bill. To eliminate income tax, many executives join the $0 salary club. Founders like Mark Zuckerberg and Elon Musk often draw little to no official salary, completely removing their exposure to high-bracket income taxes. But billionaires still need cash to fund their lifestyles. If they sell their massive stock holdings to get that cash, they trigger a 23.8% capital gains tax. A capital gains tax is a federal levy on the profit made from selling an investment. Selling is incredibly expensive. This visual scale illustrates their alternative, borrow. Instead of selling, they use a securities-backed line of credit, or SBLOC. An SBLOC is a revolving loan where you pledge your investment portfolio to a bank as collateral. The red block shows selling an asset and losing nearly a quarter of it to taxes. The green block shows borrowing against it, costing only around 4% in interest. As the green block grows, it highlights the core legal mechanism at play. United States tax law does not classify borrowed money as income. A billionaire can withdraw millions from an SBLOC completely tax-free, while their original stock portfolio remains intact and continues to compound. Debt is typically viewed as a financial burden. At this level of wealth, it acts as a highly effective shield, extracting limitless cash while keeping taxable income firmly at zero. Eventually, those massive bank loans have to be resolved. That brings us to step 3, die. This line graph tracks a single investment. An original purchase of $500,000 grows to $50 million over a lifetime. That $49.5 million gap is the taxable gain. But under U.S. law, when the owner dies, the cost basis of the inherited asset legally resets to its current market value. The cost basis is simply the original purchase price, recognized by the IRS for tax purposes. Watch what happens to the gap, it vanishes. The baseline snaps up to the current value, permanently erasing every dollar of capital gains tax that accumulated during the original owner's lifetime. The heirs inherit the portfolio completely tax-free. They sell off a small fraction of these newly cleared assets to repay the outstanding bank loans and keep the vast majority of the fortune intact. This mechanism transforms what was originally a temporary delay in paying taxes into a permanent elimination. It resets the clock, creating a continuous repeating engine for American dynastic wealth. Today, the financial industry has lowered the barrier to entry for these tools. Investors with as little as $100,000 in taxable brokerage accounts can now access smaller-scale blocks to fund major purchases without selling stock. But deploying the strategy without a billionaire safety net carries severe risks, specifically the danger of a margin call. A margin call happens when a dropping market shrinks your portfolio value, forcing the bank to demand immediate repayment or automatically sell off your assets. For a middle-class investor, a sudden downturn forces a catastrophic liquidation at the worst possible moment. Meanwhile, the regulatory environment is shifting. The IRS is deploying new funding to rebuild its enforcement capacity, establishing dedicated teams specifically targeting complex tax avoidance by high-net-worth individuals. At the same time, lawmakers are also advancing proposals that would directly dismantle the strategy. Recent legislative pushes aim to either eliminate the stepped-up basis entirely or impose a minimum tax on unrealized gains. These reform efforts face fierce resistance. Financial industry lobbyists consistently mobilize to protect the current code, heavily defending a stepped-up basis provision that costs the U.S. Treasury an estimated $58 billion in lost revenue every single year. Buy, borrow, die operates exactly as its architects designed it. It reflects a system built to protect capital and generational wealth over daily labor. The math is perfectly engineered, leaving voters and investors to decide whether to learn the rules of the game or demand they be rewritten.